William J. Bernstein, The 4 Pillars of Investing, Lessons for Building a Winning Portfolio. Are you looking for the key to successful investing? Look no further. Dive into the book summary of The 4 Pillars of Investing, Lessons for Building a Winning Portfolio by William J. Bernstein. Discover the secrets of making the most of unpredictable stock markets and learn the value of stocks, bonds, and other investments in the long run. Gain insights into the world of financial history, allowing you to recognize and avoid traps that most investors fall into. As you traverse through different investment strategies, learn the importance of indexing, asset allocation, and how to secure a comfortable retirement by investing in equities. As you embark on this journey, you shall unravel the truth. Investing, after all, is not just about making money but outsmarting your own biases and maximizing returns.
Stocks, the long game. Stocks are a long-term investment, and short-term moves are unpredictable. From 1790 to 2000, investing in stocks is equivalent to a portfolio worth $23 million. The wise investor knows that trying to time short-term moves is futile. Stocks are the most lucrative investment in the long run, averaging 9.89% in annual returns compared to bonds, averaging 4.85%, and treasury bills, averaging 3.86%. Even though stocks are the most lucrative, they can also produce gut-wrenching losses. The key is to understand that the overall path of the market is steady, while short-term moves are like a dog on a leash. Young people should pray for a market crash so that they can purchase their nest egg at fire sale prices. Unlike shares, bonds don't rise significantly over time, so if you want the heftiest returns, you must stomach devastating losses. The art of stock investing. To secure a comfortable retirement, invest in equities. Investors divide shares into growth stocks and value stocks. Surprisingly, bad companies can make the best investments. Walmart is a quintessential growth stock. It manages well, gains admirable feedback, and is financially robust. Struggling rival Kmart is the epitome of a value stock. The company landed in bankruptcy court. Yet, investors know that Kmart is riskier than Walmart, and demand higher returns for investing cash in such a struggling enterprise. Moreover, most investors have no idea how much a share is worth. When you buy a stock, you're buying the income it will provide. If you're young and have decades to go before retirement, hope for downturns, as market crashes are a gift for young investors because they can buy shares at a deep discount. Most investors have trouble with bargain hunting. Sophisticated investment funds own many stocks. Owning a handful opens your portfolio to risk. History's lessons for investor success. Investors can gain valuable knowledge by studying financial history, according to author Jason Zweig. In particular, history demonstrates how stock markets can become irrationally exuberant or illogically despondent. To succeed in the stock market, the savvy investor must recognize the telltale signs of these market conditions. For example, in 1999 to 2000, the market valued Internet Capital Group 10 times greater than the worth of the companies it owned, exemplifying a mania. Inversely, the 1970s saw a decline in stocks despite inflation soaring, prompting pension funds to rework their asset allocations to favor investments like real estate, futures, gold, and diamonds. By studying these historical scenarios, investors can learn about the herd mentality that drives investors to sell in bad times and buy in good ones. The author suggests that investors shouldn't complain about losses because they are inevitable. Instead, they should learn from them so that they can achieve greater success when investing. The illusion of investors' rationality. Humans' behavioral biases impede rational investment decisions. Investors deceive themselves into believing that they can outsmart the market. Asset classes' performance is unpredictable, and recent successes do not guarantee future profitability. Betting on long shots is entertaining, but indexing and asset allocation offer better returns despite being perceived as mundane. In the world of finance, the conventional wisdom suggests that investors make rational decisions by calmly applying a discount rate before buying or selling. However, the reality proves quite different. Humans are social beings who are highly prone to follow crowds into unprofitable trades. The masses periodically favor certain types of companies, and stock winners of the popularity contest are unlikely to continue offering stellar returns. Investors tend to fall victim to overconfidence, which leads them to deceive themselves into believing that they can outsmart the smart money. They underestimate the sophistication of professionals who have access to high-end databases that enable them to screen thousands of publicly traded companies based on hundreds of metrics. This ignorance misleads investors into thinking that they have an edge from their value line subscription and a basic understanding of price/earnings ratios and dividend yields. Many investors suffer from behavioral biases that impede rational investment decisions. The recency phenomenon leads people to believe that the immediate past is a prelude to the future. Asset classes tend to perform well for a few years, then fall apart for a few years. This phenomenon is known as mean reversion. However, sometimes an asset class defies the odds and outperforms for years. Investors tend to be overly scared of short-term losses, which triggers their myopic loss aversion. This fear causes investors to spurn risk without realizing the graver danger of long-term underperformance. Instead of stock picking and market timing, investors should focus on indexing and asset allocation. Despite being perceived as mundane, a snoozer portfolio of value stocks like Caterpillar and Ford proves more profitable. Investing is a serious matter, but investors seek excitement in their investments, which leads them to make poor decisions. High-risk, high-reward bets are alluring, and initial public offerings of sexy companies tend to attract more capital than they should. Humans' high level of self-regard is their greatest enemy, as most investors remain overconfident due to simple ignorance about the sophistication of professionals. In conclusion, humans' behavioral biases impede rational investment decisions. Investing based on the illusion of knowledge and outsmarting the market leads to negative returns. Asset classes' performance is unpredictable, and recent successes do not guarantee future profitability. Betting on long shots is entertaining, but indexing and asset allocation offer better returns despite being perceived as mundane. Avoiding brokers and financial media traps. Investing in the stock market can be challenging, especially when faced with brokers who prioritize their own financial gains over their clients and financial media whose main goal is to stoke volatility. This article highlights the importance of scrutinizing brokers' fees and avoiding load fees when investing in mutual funds. It also emphasizes the need to ignore financial publications that profile money managers and to seek out expert advice from scholarly journals instead. Investing in the stock market can be a daunting task. Even investors who have mastered the theory, history, and psychology of investing must navigate the pitfalls of dealing with brokers. These intermediaries, whose priority is maximizing returns, often aim to do so at their clients' expense. To get licensed as a stockbroker, a person does not need to demonstrate their understanding of the equity market, only to pass the Series 7 licensing test. This leaves room for the unsuspecting investor to be taken advantage of. The U.S. Securities and Exchange Commission conducts minimal scrutiny of brokers' fees or their performance for clients. This lack of accountability sets the scene for one of the most significant concerns that investors face: the spread, the difference between bid and ask prices. Unfortunately, small investors who cannot compete against the larger players in the market often end up paying a higher price gap. For a large stock like Walmart, the spread is typically less than 1%. However, the gap can grow to as much as 6% in thinly traded securities, costing investors significant amounts of money in the long run. It is also essential to watch out for load fees when investing in mutual funds. Class A shares of a mutual fund come with a front-loaded fee of 4.75%, significantly decreasing potential returns for investors who hold on to their shares for the long term. Backloaded mutual funds also come with fees upon selling, resulting in less return with worse performance. Several financial institutions, including Vanguard, Fidelity, Charles Schwab, and TIAA-CREF, offer index funds that eliminate or significantly reduce these costs through the use of reasonable expense ratios. It's also important to be wary of financial publications and media that profile successful money managers as experts. The problem with this coverage is that it pushes a lot of money into the manager's fund at a time when the market has already peaked. As a result, it is better to ignore financial programming on television, cancel subscriptions to financial magazines and newspapers, and turn to scholarly journals for information about investing. The Journal of Finance and the Journal of Portfolio Management are just a few examples of trustworthy sources that can provide expert advice. In conclusion, investing in the stock market can be confusing, but by being aware of brokers and media traps, investors can make informed decisions that maximize their profits while minimizing risks.
As you conclude exploring the 4 pillars of investing, a key takeaway has emerged. It pays to be savvy in the world of investing. Understanding the historical context of financial markets is vital for recognizing trends, spotting overvalued or undervalued opportunities, and avoiding costly mistakes. Embrace the long-term perspective and accept that short-term fluctuations are both inevitable and unpredictable. Prioritize indexing and asset allocation over stock picking and market timing to stay on the advantageous side. Finally, be aware of your own biases and never forget the need to constantly educate yourself on the ever-changing landscape of finance. By mastering the 4 pillars, you will pave your path to building a winning portfolio and a secure financial future.